Welcome to 2023 from Core Wealth. Hope it's one of your best years yet. We are trying something new this year and we're recording on the outside of our building. It's a lovely summer's day and we thought we'd switch it up a little bit. We're going to be covering what happened in December, but then looking at 2022 as a whole as to what happened in financial markets around the world. So if we have a look at markets around the world, December was pretty much a continuation of what we'd seen earlier in the year, and particularly in the second half of the year. A bit of a slower economy globally, markets pulling back in the US again. But there were really five things that stood out last year. If we look across the year as a whole, the first one was the Russia-Ukraine crisis, the war happening there. That had a big knock-on effect onto energy prices and oil prices, which shot up very strongly, but did peak mid-year and have come back quite a lot since then. The result of that was then thirdly inflation taking off and inflation rates really being very high in multi-decade highs in Europe, in UK and in the US. And then in response to that, central banks then pushed up interest rates and have been pushing up interest rates to try and quell inflation. And then the last big thing in the news last year was COVID, a resurgence of COVID in China and them closing down their economy, which meant that they had much lower economic growth in 2022. There were really two big points in the South African local news, and the one was on the political front, and that really culminated at the ANC's National Elective Conference in December. There was lots of noise that Ramaphosa was going to be impeached and would have to step down. There was a strong pushback from those against him to try and get him out of office, which didn't succeed. And the National Elective Conference, he ended up winning and being appointed as president again for another 5 years of the ANC, with a strong enough majority that has enabled them to push forward with a lot of the reforms that are needed. So a tumultuous year, but ended actually quite good from a political point of view. Then the other one was obviously load shedding. Andre de Ruyter, the CEO of Eskom, resigning in December, effective only end of March. But that is a big item that does need to be resolved, and we'll have to see in 2023 how that progresses. So let's see how the markets reacted to all of these things we've just spoken about. You can see that the global developed market in the month, the share market was down, as was the emerging market share market, down 1.3%, and the developed down over 4%. The JSE was also down just over 2% for the month. But then most of the other areas were, from an interest-bearing point of view, were up into slightly for the month. If we have a look at the year as a whole, the picture is quite similar, but a lot bigger in absolute terms. We can see the developed market equities down 12.7% for the year. That's in rands, however, and the rand did weaken against the dollar by some 6.6% for the year. That means you were getting close to 20% down if you had a developed market equity portfolio. Emerging markets were about 2% worse off than that for the year. But South Africa, the South African equity market was actually up, while albeit only by some 3.6%, but still positive and a lot better than having lost almost 20% in hard currency terms. Our bond markets and cash were also positive for the year. Listed property slightly positive for the year. One of the other really pronounced things that was different in 2022 from most other years, if we go back over even the last 100 years, that we saw the global equity markets, as I mentioned, down close to 20% in hard currency terms, but also the global bond markets coming off strongly last year as interest rates started to rise and the bond values then on the back of that fell. And that was one of the few times, even in the last 100 years, where you saw both equities and bonds really coming off substantially, making it quite difficult to find anywhere to hide, as it were, if you were an international investor. If we have a look now longer term, we can see a similar picture to what we've been talking about at previous wrap-ups. We can see over the last 3 years the South African equity market giving you a reasonable real return, i.e. above inflation, some 12.7%, while inflation is at 5.3, so getting close to just over 7% in real terms, which is what you'd expect from equities over the longer term. Global equities, the developed markets, also giving you even stronger returns than that over the 5 to 15 year periods, while the emerging markets have still not caught up. And we do think this is an opportunity looking forward, although positive over 3 years, still in sort of mid-single digit figures. So if we have a look at how this is translated into, have you as our clients, have your portfolios benefited or not? And we've got the 3 sections we'll cover here: our South African portfolios, our global portfolios in dollars, and then our global portfolios in British pounds. So if having a look at our local portfolios for the month of December, most of them green, in other words, outperforming their peer groups, but the returns are low and some of them even negative. But we've still managed to outperform our peers in all but one of our strategies, which was marginally behind the peer group. However, if we have a look over the last year, we can see that we've generated some excellent outperformance relative to peer groups, the lowest being 1.2% in the year and the best being 5.8% on our flexible strategy. So outperforming the peers well, and that continues to feed through to the since inception returns, which are over much longer periods of time. And you can see again, they're all green. If we have a look at the US strategies, a very good year in relative terms. In absolute terms, I'd shown you earlier how weak the global equity markets were. So our strategies for the year were also negative because we're invested in those markets, but have managed to invest in better areas than our peers, and we've seen some good outperformance of these strategies of their peer groups. And then the since inception returns now, which are over 6 years, now on average over 1% additional return being added there. And then lastly, if we have a look at the UK's global strategies in pound sterling, then we can see here that these strategies are now just over a year old, but having generated some excellent outperformance of the peer groups over this initial period in time, which we're very happy about. So all of that means that while even when things are tough, we need to be adding value to clients' portfolios, and these figures demonstrate that we've had a good time of doing that over the last while. So if we have a look at what we're expecting in 2023, here are some 5 main bullet points. The first one is that we're expecting company earnings to slow down in the US. Firstly, the growth of earnings to slow, but then also their margins to slow, company margins to slow, and that will see results coming out at lower levels than previously expected, which could see stock markets, particularly in the developed world, coming off somewhat this year, we think. The second thing is that the labor markets in the US have been very, very tight. In other words, there haven't been enough workers for the amount of jobs that are out there. And as company profits start to diminish, we expect companies, and we've already started to see some of the big players, particularly in the tech industry in the US, cutting jobs. And that will then reduce pressure on the labor market, which will reduce the pressure on inflationary increases in wages, which will be a good thing because inflation is something that the US is trying to reduce at the moment because they're at too high levels. So the third thing that we expect to see happening this year, and we've started to see that trend change earlier in 2022, was that we will see a softening in both energy prices and in food prices. These are things that fed through to inflation. We've seen vegetable oil prices coming off, almost halving from their peaks earlier this year. We've seen cereal prices coming off, and then the oil price that peaked at over $120 a barrel, down at the moment at around $80 a barrel. So all of those things are then positive for global inflation in that they feed through into lower prices. The next thing on the back of that is that we expect a weaker US dollar. The US Fed has been raising interest rates. That's always good for a country's currency in the sense that it makes it stronger, but we expect them to to stop raising rates later on this year, and that could then see the US dollar weaken again after having strengthened against virtually every currency around the world in 2022. And then the last thing is just China, and China's expected to grow much better this year. They're opening up their economy after closing it down to a large degree because of COVID, and we expect then that to have a positive effect, particularly on resources around the world as the economy starts to grow at above 5% probably in 2023. So we've had a very good 2022 in terms of how our portfolios have performed relative to our peer groups. That was in a very difficult environment, in the sense that the absolute returns were not very high, but yet we've managed to add outperformance to our clients' portfolios. We do actually expect 2023 to be a better year from an equity point of view in absolute returns. The media is really trying to hype up the global recession, and there is going to be a slowdown in economic growth globally, but we don't think it's going to be an all-fall down situation at all. In fact, we think that last year's equity market reactions, those big negative returns globally, were preempting the slowdown in economic growth in 2023. So it is possible that we actually see equity markets giving reasonable returns in 2023 globally, as well as in South Africa. As always, we are focused on the long term and making sure our portfolios perform well for our clients over the long term to achieve their needs. If you've got any questions, the start of the new year, please give your advisor a call. We'd love to chat, and we look forward to seeing you during 2023.